Hello, good afternoon. Welcome to MF Corner on CNBC TV 18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Now, today we're going to be putting the spotlight on the SEBI proposal that has come in for new mutual fund fees. And this is the restructuring. This is just a proposal as of now, but there's a lot of changes that I've spoken about, right? Removal of additional expenses of 5 basis points on the entire AUM. Furthermore, they're talking about some differential TER-based performance, statutory levies that could come in on over and above brokerage cap, a lot more changes and announcements or proposals that they've made. Now, what does this mean for you as investors? What will it mean for brokers as well? To understand more of this, we have Feroze Azeez, joint CEO at Anand Rathi Wealth, as well as Mohit Gangs, co-founder and CEO at Moneyfront, to discuss all of this and explain us what it will mean for investors. Feroze as well as Mohit, good afternoon and thank you so much as always for joining us on the show. Feroze, let me start with you. The most important one that everyone is talking about in the last couple of days was going to be the meaningful 15 to 25 basis point reduction in this expense ratio. How meaningful is it actually for investors, and will it actually translate into visibly higher take-home returns for an investor if this goes through?
Yes, good afternoon, Vinny. If you look at how a 15 basis point compounds on a certain amount, of course, it compounds to something sensible. On a 10 lakh amount in about 10 years, it becomes about 49,000, somewhere about 50,000 rupees is what you end up saving as cost for something as little as 15 bips. Assuming the performance doesn't get impacted. When you reduce cost, when you reduce brokerage, today an asset management company has 10 brokers roaming around them to give them research. When there's lesser money to spend, it doesn't mean that the performance doesn't drop. See, like in the US, everybody's not able to beat the benchmark. In India, 70-80% of them are actually in the long run beating the benchmark. The cost being higher could very well be the reason of it. So point is, if all else equals, if performance doesn't drop, a person makes 50,000 more. Assuming nothing happens to value when you reduce cost is a wrong hypothesis.
Feroze, what's your thought on that? And does excluding also the statutory levies from TER make cost disclosures more clearer, or maybe it is going to be a bit more of a confusion that comes in for an individual investor?
It is one of the biggest mysteries to solve, Vinny, being a large distributor, a non-banking financial services distributor, a non-aggregator. We are the largest. I have a 25-member colleague team which tries to only focus on mutual fund research. When it comes to deciphering what is the total expense from the TER, for us to understand our commissions, we have to decipher something called distributable TER, which we call in the nomenclature DTER. Deciphering this difference has been no bigger mystery could I have in the mutual fund industry. So I can't welcome this move enough from SEBI to separate costs in statutory costs, brokerage costs, STTs, all those costs and exchange cost out of the management fee or the TER. I think is a brilliant move, point one. Why do I say so? First step of managing anything efficiently is to separate it. When you separate it, when it's visible, over a period of time, efficiency on each count will count. When the consultation paper speaks about brokerage, it highlights the differential brokerage which a broker is charging for the same asset in arbitrage fund vis-a-vis equity fund. Why should equity funds be charged 8 paisa brokerage or 10 paisa or 12 paisa brokerage as against arbitrage fund to buy the same stock be charged 2 paisa brokerage? So that's the second point I'm making. So it's the same asset class. Of course, arbitrage has a different return expectation. Equity has a different return expectation. But brokerage can't be different depending on clients' risk appetite and risk expectation. So I think I love the fact that SEBI is getting into microscopic understanding and macro management.
Absolutely, that's interesting. There are a lot of points that you made. So, Feroze, what is it and why is it that if it's been into consideration, what is the reason that it's not come into play? And do you think, this is going to pump up the fund managers to maybe think before they invest in and give better returns because of this?
Vinny, I think it has not happened, one, because it is a little more complex than a PMS. Like Mohit mentioned, a PMS. A PMS is, and Feroze's account is different, your account is different, Mohit's account is different. So charging a person is so much more easier if it's not a pool account, one. Second, PMSs charge on absolute profit share, which I think is very unfair, because in 2007, I remember one client had to pay 12% fee to a guy who underperformed Nifty by 4%. Nifty did so well, he underperformed Nifty, but the profit share was 20%. So you're paying an underperforming fund manager 11 to 12% profit share. That's the day when it hit me. I was new to the industry. It hit me that how a client's agreement can put them into such big trouble. So coming back, trying to create a profit share model, a profit share model on a pooled account is tough. Third, does mutual fund industry need some innovation? Definitely. Mutual fund industry has been losing or churning a lot of talent. It's unfortunate when I speak to CEOs of asset management companies, they say, यार fund manager को retain करना बड़ा कठिन हो गया है. इतने पैसे देने के बाद भी कठिन हो रहा है, मतलब talent has to be stable or be attracted, and this can definitely be one such way. But I think the profit share should be on relative performance rather than the PMS industry's bad norm of absolute performance.
Okay. How will this impact marketing or frequency of NFOs? Do you think that could see a step back now? What are we keeping an eye out on here now?
I think NFOs will have very little difference, because see, the smaller the scheme, the larger the expense ratio chargeable. If I'm spending money to collect NFO money, that's been one of the largest motivations, that you bring in a new idea, maybe a theme. Of course, SEBI very rightly expected it, is why in 2018 they categorized and gave one category and one scheme in each category. Now, of course, they're mulling over it for scheme sizes greater. So what an AMC would do is bring a new theme. There's more talking point. Distributors are engaging with investors and getting 5,000, 10,000 crores. Will that slow down? Because of this, the answer is no. Because there's an income tax method of charging. The first 500 crores, there's a separate charge. Then the next 250. So even if there's a 50,000 crore fund, it's going to be charged. It is going to be benefiting from the first 500 crores having a larger expense. So newer the fund, larger the expense ratio, weighted average on the slabs. So that will not get impacted. Second, I think AMCs today are also charging for brokerages, which I think one thing which if we learn from the UK market. UK did this. They said that a broker has to charge brokerage for execution separate and research separate. After that, the mutual fund industry in the UK has taken a hit. Because brokers stopped giving research because they were not getting paid enough. And when research is not there, the asset management company needs to employ more people and more buy-side analysts. That can actually bring down the profitability of an asset management company business. So the industry went through a little. So UK is mulling over reversing that decision, which we are today contemplating.
So maybe this decision is something that they should avoid going for it. Is that some request that you all have made there as well, Feroze?
No, I think I'm sure they would have examined. SEBI is one of the most respectable regulator. I've spoken to them in different contexts. But I'm saying this has to be examined. UK can't be just cut, copy, paste. But if UK is planning to reverse the decision, then definitely requires more homework for us to go that direction.
Absolutely requires more homework. You know, before this is just a proposal now, there'll be a lot of discussions that will happen as well. Feroze, what's your view coming in as an SIP investor? If I'm monthly investing, how much of the benefit that I'll be able to see visibly in the long term?
In my opinion, any investor focusing on cost, and if he is young, I think it is stupidity in my opinion. Why? Because if you're so focused on cost, you also have another alternative, which is direct. Do the homework, do the research, look at MF Corner, make a scheme choice and get 1% reduction. Why are we waiting for a 15 paisa reduction? So that's point one. Anybody who pursues cost. Now I analyzed I analyzed almost 9,400 portfolios transactions wise who don't invest in Anand Rathi model portfolio. 94% of them underperformed Anand Rathi model portfolio in spite of I have a larger cost. That's one. I think SEBI, I have a message for SEBI. SEBI has already given direct alternative. See, if somebody in the value chain is building a business, be it the distributor or the asset management company, he needs to be able to project 10 years, 15 years. If you expect an investor to invest for 10 years and 20 years, a distributor needs to make his business plan for 10 years, where there are certain expenses, variable costs, fixed costs. So tinkering around with that too much is not advisable if you really are in the nascent stage of the industry, which is what mutual fund is. If you have to get to 300 lakh crores, the distributor, the asset management company should be able to project its costs and its profitability over 10, 15, 20 years. Every 2 years, changing expense ratios, I think, is being missing the woods for the trees.
Okay. That's an interesting take there. And thank you so much, gentlemen, for joining us, explaining us what it means for investors as well. Feroze as well as Mohit, thank you so much for joining in on Mutual Fund Corner.